For centuries, gold has been recognised as a safe haven asset and store of value in times of stress and uncertainty. The precious metal has traditionally been valued by investors for its ability to provide financial security against unexpected economic shocks. Indeed, gold hit a new peak in December 2023, driven by the continuation of geopolitical tensions in regions such as the Middle East and Ukraine. But interest rates also play a significant role in determining the price of gold. We've seen over the past couple of years, central banks have initiated a series of aggressive interest rate hikes to cool inflationary pressures. And although US economic activity has continued to show impressive resilience, the anticipation of rate cuts in the near future has underpinned support for gold prices, which recently hit record highs. So if we go back to basics, we need to understand that there is typically an inverse relationship between gold and real interest rates. That is, those adjusted for inflation. This means that as interest rates and real bond yields rise, the appeal of gold falls. Higher interest rates raise the opportunity cost of holding gold as it doesn't offer any interest. Conversely, lower rates are normally positive for gold. However, there have been instances where this correlation does not hold. For example, gold prices have shown resilience even when real rates rose due to concerns over economic growth or potential policy errors by the US Federal Reserve. This indicates that factors other than interest rates can also impact prices. In recent years, the purchase of gold by central banks has increased as some countries seek to diversify their reserves towards safe assets. Exchange-traded funds, ETF buying, and positioning in the gold market by major investors and speculators can also move prices. From a historical perspective, there's little doubt the Fed's interest rate decisions significantly influence the gold market. Higher interest rates lead to increased borrowing costs, typically reducing gold demand and lowering its price. For example, the 2015 Fed rate increase, its first in many years, resulted in a decline in gold prices. When rates were cut during the pandemic in 2020, prices surged over $2,000 to a record $2,075 in August 2020. However, the start of the Fed's rate hiking cycle in March 2022 saw gold prices tumble. The upcoming year presents both challenges and opportunities for traders and investors of gold. The policies of the Fed will be a crucial factor, as they will determine the direction of interest rates, which in turn affects the US dollar and gold prices. Current money market forecasts suggest little likelihood of an interest rate reduction before June, with expectations set for 325 basis point cuts priced in for the remainder of the year. The US economy's positive momentum that showed 3.3% growth in the last quarter of 2023, coupled with a mixed picture of inflation, means the Fed can be patient with easing policy. This environment typically does not favour gold investment, as interest rates could stay at a higher level for a longer period of time. However, investors are forward-looking, and any signs of an economic slowdown could lead to a rise in gold prices as the markets begin to anticipate interest rate cuts once more. Positioning by speculators and major investors also plays a critical role in determining gold's future price direction. At the beginning of the year, net long positions in gold decreased, with further reductions seen in February as the prospects for interest rate cuts faded and the dollar strengthened. Nevertheless, net inflows are expected to increase if interest rates start to fall. As for central bank buying, according to a 2023 survey by the World Gold Council, 24% plan to increase their gold reserves in the next year, potentially driving long-term upside in gold prices. Additionally, physical demand for gold in China and India appears to be solid, even with current high prices. In conclusion, there are multiple factors that influence gold prices, and central banks' decisions on interest rates will always be important. In the current environment, any delays on the road to lower inflation could result in rates remaining higher for longer than current market predictions. However, gold has recently reached new peaks due to other contributing factors, including central bank buying and continuing geopolitical risks.